In this environment where stocks continue to go down as there are economic concerns, there are some stocks that are less prone to a recession. And in this video, I'm going to cover one of those names. But first, let me run that intro. What's up, guys, and welcome back to the channel. Let's dive right into this one, which is a stock that has increased 18,000% since it's gone public. And I generally don't look at stocks that are near their all-time highs, but in this video, I'll explain why this one might be different. So what we're covering is Casey's, which is a gas station convenience store with hot prepared foods. And if you don't live in the Midwest, you may not necessarily be aware of this name. So they have 2,400 locations in 16 states, but you notice how they're all just centered around that one area, which is in the Midwest. And the reason for that is because, and I'll explain it later on in more details, part of their competitive advantage is the fact that they utilize distribution networks that can travel to all of these states. And so it doesn't make sense that they're scattered across the US if they're out of reach from their distribution network. Now, overall, the convenience store in the US still continues to be highly fragmented. Now, I'm one of those people who thought that with Walmart becoming more and more dominant, you would see convenience stores go away. In fact, you've seen it go the other way, where mom and pop convenience stores have started to go away, but you're seeing these large national type convenience stores or dollar stores really take a piece of the overall retail market space. And that's kind of where Casey's fits, at least in the food and grocery space. And that's what seems to be what their strategy is. They're not really the dollar store model, nor are they the small grocery store model. What they really are is a mix of small grocery and small food takeout. Notice how they say that food service increased by 280 basis points as a percentage of their inside sales in the industry from 2018 to 2019. And that really speaks to the directionality of the convenience store industry. They're really pivoting to food sales. But notice that there is a sort of like a blue ocean opportunity here, because approximately 63% of convenience stores are owned by operators that only own from 1 to 10 locations. The national guys, the people who own 500 or more locations, are only 21% of the market, so a fifth of the overall convenience store market. So it is highly fragmented. And you can see that Casey's has humble beginnings. They have been around for 50 years serving the Midwestern communities. And so it's a strong and recognizable brand in those states. And this is what I mean about it there being a blue ocean opportunity. Notice how 73% of the towns where Casey's has a regional footprint is white space that they can still address. And in addition to that, notice that what I love about this company the most is that their bread and butter are towns with 5,000 or fewer people. And so that's very interesting and exciting. Now, I happen to live in a town that is about that size, and a store, a grocery store, or a convenience store like Casey's would make a lot of sense here. And in fact, as this town is growing, we do have a lot of food providers that are coming out here. Now, look, I grew up in the city of Toronto, so one of the biggest cities in North America, and whatever you want, you can get. But when you get into these smaller towns, these small regional convenience stores that are open late, they make a big difference in your quality of life in these towns. And so I see why Casey's is very successful in these smaller towns. There just might not be enough foot traffic for these national brands to come in, like a Pizza Hut or something. And why do I mention Pizza Hut? Because notice that I've actually highlighted that in the prepared food and dispensed beverage section. Notice that they're very well known for their pizza. In fact, that's really what Casey's is known for. They do have a bakery and they sell other stuff, but it's their pizza and their breadsticks, which is what attracts people to the store. They also do have groceries, they have tobacco, they sell alcohol and non-alcoholic beverages, and all of what you would expect in convenience stores. Now, what I do want to point out though is that although 64% of their revenues are fuel, notice that only 34% of their gross profit comes from fuel. So the vast majority of their gross profit comes from grocery, prepared foods, and other. And notice how high of a margin their prepared foods are. It's only 9% of their revenues, but amounts to 26% of their gross profit margins. So they absolutely need to continue to grow the offerings in the prepared food and dispensed beverage segments because it's highly profitable for the business. And this is what I mean about why they're highly concentrated in the Midwest. The secret to their success is that they run their own distribution network. And so it enables them to have a best-in-class inside gross profit margin. Now, these margins aren't high, and I'll show you that later. And so the fact that they can rely less on third parties is very important to them. And so I don't see them growing out of the Midwest until they first drop in a distribution center. And I don't see them really doing that because they still have a lot of area to grow. And what's really cool here is that they're not just opening new stores, but they're also open to large acquisitions in their home territory, like the 3 acquisitions that they have made thus far in fiscal year 2022. And I can't underscore how important it is that they focus on acquisitions that are not just accretive to EBITDA, but also focused on return on invested capital. And the reason why I bring that up is because anybody can make an acquisition and say, hey, this is accretive to EBITDA, but you might pay a huge amount and your overall return, like your return on equity, goes down because you paid too much. So what they're really saying by focusing on return on invested capital is that they're not willing to overpay for these transactions. And that, as an owner, is super important to me. And this is what I mean. They actually call out their return on equity. So they've never dropped under 15% over the last, or at least since 2014. And so I really like the fact that they're focused on their return on equity measures. This tells you that this is a very shareholder-focused company. And at the end of the day, if you're going to own a company's shares, the long-term results that you're going to generate is going to match the long-term profitability of the company or the long-term return on equity. So this is very important as an investor that they remain focused on this. And essentially it tells you that they're solid stewards of capital. This has Warren Buffett written all over this name. Now, this is what I mean about this being a tough business. Notice that their gross profit margins are in the 20% area, but their net income margins are in the low single digits. So this is where this business falls from being an exceptional to an okay business, because it's very easy to screw this business up. This is the same area where I would throw in Walmart or Cardinal Health. They're all very low margin type businesses. And so you have to keep that in mind if you're going to be a investor in this opportunity, that this is a business, once again, that can be screwed up pretty easily. You know, you have some shocks in the supply chains or whatever, and next thing you know, you're running big losses. So just be aware of that. Now notice, guys, that they are paying a small dividend, but most of the capital is actually going to grow the business. And so they even have taken on debt for their acquisitions, which they did in 2022. So you can see that with the $261 million of debt that was taken out. And so this is good because they're putting their money where their mouth is. They're saying that they have blue oceans opportunities and they continuously invest in them. So that's good to see. Now, Barron's put out an article where they're saying that this is an opportunity that could potentially be recession resistant. And effectively what they're saying is that fuel and tobacco is relatively inelastic. And the other thing is, with high gas prices, it doesn't really make a lot of sense for convenience stores to undercut their competitors, because they just won't attract enough customers to gain enough market share to offset what they would give up in lower margins for fuel. And so that actually is something that contrasts with other parts of retail, where inventory gluts have translated to deep discounts on more discretionary items. Think Walmart, Target, etc. Now, one portfolio manager notes exactly what I'm looking at when it comes to this opportunity, is that are they improving their product offerings, especially with hot foods? And so notice that this portfolio manager does say that Casey's has continued to improve their product offering and improve value. So that's really good. And then he goes on to say that the most expensive item that Casey's sells is a $16 pizza. And if you combine that with $5 breadsticks, that's one of the cheapest ways to feed a family of 5. And so that's what I mean when I say that Casey's is known for their pizza, guys. Now, he goes on to say that the headlines look ugly with inflation and everyone waiting for a recession, but it looks like Casey's is navigating it well, and it's not detracting from the long term. Now, here's what Casey's guidance has been. They expect inside same-store sales to rise between 4 and 6%. So that would be that 34% of their revenue. And they expect same-store fuel gallons to be flat to up 2%. So that's that 66%, or that would be the 64% of the revenue. The 36% of the revenue is their inside same-store sales. And so you have to sort of account for that when you grow out sales for the year, and I'll show you how I did that in the following slides. They also expect to grow around 80 stores this year, and so 80 stores reflects approximately 3% new stores in their overall sales growth plan. So now just moving into the revenue forecast, you can see that if I confused you in the last slide, it'll make more sense here. So you can see that 80 new stores means that the number of stores grows by 3.3%, and the sales per store actually increases by 3.1%. And this is because inside same-store sales increases by 5%. Remember, they said it would increase by 4 to 6%. So I just took the midpoint, multiply that by the 36% of total revenues, which is what inside store revenues represent as a percentage of their total revenue. And then to that, you add the 2% increase in fuel sales. Now, they said fuels would increase between 0% and 2%. I'm just taking the 2% just because inflation has been running high. So 2% times the 64% of total revenues. So you add those two up together, and you'll get to that 3.1%. Now, the Patreons, you guys actually have access to this model, so you can click into that cell and see the formula. But one interesting thing about retailers is in order to forecast out revenue growth, all you have to do is add up the rate of growth of the number of stores plus the sales per store. And that will give you the percentage revenue increase. So that's a neat little relationship that you guys got to be aware of when you look at retailers. Now, notice that I'm keeping their gross margins somewhat high at around 22 to 23%. So there is a little bit of optimism in my modeling here, but that does reflect reality as far back as 2016. So I do believe that they will maintain those margins. Now, guys, I want to end this video off with the valuation for Casey's, but first I got to remind you guys that approximately 80% of you guys are not subscribed. So if you have an opportunity, please consider subscribing to the channel. Now let's dive right into the valuation so you can see that this, I believe, is a good, not great business. Now, the reason why I don't think it's great is because of their low net income margins, but I do believe that it's fairly priced. I would love this company at 12 times earnings. Right now, it's trading at approximately 18 times earnings. So I will wait for it to come down a little bit more, but I did want to put it on your radar as it is a name that is somewhat recession proof. Now, how do you get access to that model and that valuation? Well, you can get access to that model and all the other models that the Patreons get access to at the lower tier of the Patreon. And if you want to join us for an epic live presentation every month, you can join us on that higher tier. Now, another name that's less recession proof, but I do believe has long-term economics that are still intact is Meta. And I recently put out a video on Meta right here.